Welcome, everybody. We wanted to thank you so much for taking time out of your busy day to join us. My name is Jennifer Medina, and I'm one of the marketers here at the Annuity and Life Source. We are so proud to partner with Equitable Life and Casualty today to present to you the new Teton Fixed Index Annuity Series. This accumulation-focused product line is sure to be a fit in your product offerings. Here to bring you more information today is Carrie Freeberg. She is the Director of Product Development and is a credentialed actuary at Equitable. So with that, Carrie, I hand it over to you.
Thank you. I am so excited to meet with all of you guys today. It's been just a treat getting to know the Annuity and Life Source over the last year, We're very excited to partner with them on this product, and I'm just super excited to get to share with you guys a product that I love. We had a great time developing this product, and what we really work to do is to provide a good balance between a product that is exciting to you guys as agents. It's a great product for our company, Equitable, to support, and also a product that's providing tremendous value to your clients as well. So with that, let's go ahead and get started. Starting off, let's talk a little bit about Equitable. We may be new to the index annuity space, but we are not a new insurance company. We are actually Utah's oldest insurance company in the state. We've been around since 1935. So we've been working with customers for over 80 years. This is our first product in the indexed annuity space. And then we entered the MIGA space February of 2018 with our secure savings line, which we'll talk about for just a second. We put a tremendous amount of focus on our customer service. So I hope that as you guys get to know us and start working with us, that you see that we do things a little bit different and that we are a very friendly business company to do business with. One thing I like to point out is that Equitable is solely focused on independent agent distribution. I think that that's a really important thing to mention, because what that means, you guys, is every product that we develop, every policy, every procedure that we put in place, we are always thinking about how does it impact you guys. We're not distracted with other product lines. We're not distracted with other forms of distribution. So, little things like delivery receipts and different things, we're always coming at it from your guys' angle. And another thing is we have a lot of people from our company that actually come from distribution. People on product development and sales and marketing, new business, policy owner service. So again, as we're working to answer questions and coming up with new procedures and all of that, again, we really work very hard at trying to do our best at putting ourselves in your guys' shoes. And the whole point of that is, again, to do business hopefully a little bit different in a very, very friendly way that sets you guys up for success as well. We are licensed to do business in 46 states as well as the District of Columbia. I know we have the big blue eyesore over here in California. The good news is that we are actively working with the state to get our license there. We're literally going back and forth, and we are extremely optimistic that we will be doing business there by the end of the year, as well as in the state of Minnesota. We're having active back and forth there as well. So we're hoping that by the end of 2019, we will be in 49 states. New Jersey will be coming a little bit later. And then we're not actively pursuing New York at this point. One thing I forgot to mention, if you guys have any questions, please send them through the QA or through the chat. And what we will do is we will compile those questions and respond to you guys individually afterwards. It gets a little bit tricky sometimes answering all of those questions live on the call. So send them our way. We'll get back to you with all of our answers. Real quick, we'll just want to give you guys kind of an update on secure savings. For those of you who have been writing with us on secure savings since last February, thank you. For those of you that are new to Equitable, take a look at our secure savings line. It's a very clean MYG product. It has had tremendous success. Again, we really started in February of 2018. We got it really competitive in July of 2018. And since then, it's just really taken off. Secure Savings 5 was ranked number 4 for the most sales of an MYG in the first quarter of 2019. And Equitable, with all of our MYGs, was ranked number 4 as well. So we're very excited about how this product has taken off. And I'll get to show you guys in one second how consistent we've gotten to be with this product as well. Secure Savings 2 and 5 can both be written all the way up to age 90. I think our 2-year product is the only 2-year product in the industry. So it's so short. It's just fantastic as a lead generating source, or especially for people, you know, who have CD funds that want to consider an annuity. And then the 5-year product is just right in the meat of the market. As far as, you know, the 5-year space is so competitive right now, and this is one of the most competitive products out there. Minimum premiums 10,000, maximums 500. We are open for business though, so certainly send those larger cases our way, and we do our very best to approve them. The Elite series has a few differences that we'll talk about in a second, but it can be written up to age 85, and everything else is the same. So here are our rates. So the 2-year, again, that itty bitty short 2-year has a fixed rate of 285. The 5-year has a rate of 4%. That is certainly our flagship product. What I love is that we set these rates actually July of 2018. And you guys, we have actually held them consistent for almost a year. And these rates are through June. So we'll actually be holding these rates for an entire year, which is just phenomenal. You know, it's one thing to be able to hold uncompetitive rates consistent, but we've been able to hold some of the most consistent rates in the industry consistent for the entire year. That is just what we're really demonstrating here, is that we are not a company that's hot right now and then we're going to back off. We are here to be a long-term, consistently competitive partner to you guys. We know that it's a lot, you know, to take on a new company, get to know how we do business, and we want to make sure that once you get going with us, that you're going to be able to keep going with us and look to us to provide you good solutions for a long time. On the secure savings line, we have liquidity built in. So automatically you get RMDs starting in the first year, interest-only withdrawals starting in the first year, and 5% of account value withdrawals starting in the second year. Essentially, you can take the greatest of any of those 3 withdrawals in any given year, and the death benefit is the full account value. So this is kind of our very clean MIGA line where everything is built in automatically. And then the sister line is our Elite series. And what we did here is we said, you know what, especially when you think about the 2-year, what if someone doesn't need all that? What if they really want to just let their money sit and grow very securely for 2 years? They don't need liquidity. They're healthy. They don't think they need full account value at death. If that's the case, and we pull those benefits out, how high can we juice that rate up? And so for the 2-year Elite, look at this. We got the rate all the way up from 285 all the way up to 3.2%. Again, just on a 2-year tax-deferred annuity. Then, if someone does need liquidity, they can choose to add on the liquidity rider that they need, and they don't have to pay for all the other benefits that they're not planning on using. So if they need RMDs for 10 basis points, they can get the RMD rider. Their rate's now 310 instead of 320. If they need interest only, they can add that. If they need 5%, they can add that. A key point here is someone can add none of these riders. They can add one. You know what? They can add all 3. And if they add all 3 riders, what that means is in any given year, they can take out an RMD, and they can take out an interest-only withdrawal, and they can take out a 5% of account value withdrawal starting in the second year. So all of a sudden, you have a 2-year product with a phenomenal interest rate, and it is now one of the most liquid products in the industry. So take a look at that. Again, you can customize it however your client needs. Then we also have the 5-year Elite. This one, we weren't able to get the rate up quite as high. We did get it up from 4% up to 410. But because there's less of a difference between Secure Savings 5 and 5 Elite, we don't have the liquidity riders on it at this point. If someone does need RMDs, interest only, et cetera, then we say, go ahead and hop on over to Secure Savings 5 and go with that one. And remember, Secure Savings Elite series, the death benefit is cash surrender value. We also have spousal continuation built into it as well. So real quick, then we'll move on to the star of the show, which is Teton. Here's where the products are approved for the Secure Savings line in the green states in 39. We have all 4 products that we just talked about. And then in the 8 blue states, we have Secure Savings and Secure Savings 2. And we're actually getting ready to release Elite in Montana as well. And we're actively working on the other states too, but they just take a little bit of time. So with that, let's move on to Teton. So that picture just makes me happy every time that I get to see it. So for those of you that don't know, the Tetons are a mountain range in the state of Wyoming. Beautiful mountain range. What is a little bit unique about them is they are actually a young mountain range that is still growing. So as we were considering our first indexed annuity at Equitable, the fact we wanted it to be accumulation focused, we thought, what a great name to tie our product to. You know, to something as strong as a great mountain series, but also something that's still accumulating at the same time. So when we started working on Teton, gosh, last October, we knew we wanted to kind of come out with a product that kind of brought us back to the basics of indexed annuities. You know, 10 or 12 years ago, we didn't have income riders. It was really all about accumulation. And what that meant was our main value proposition with indexed annuities was a product where you could get a decent interest credit for the year. And the worst case you would ever have is a zero, right? So when you met with your client, you know, if the market went down 10, they were so happy with you because you had a zero to talk about, and then you got to start over the next year. Well, with income riders, great marketable benefits came with them, but also fees came with them too, right? So now when we meet with our clients, the market may have gone down, we get a zero, but now we actually go backwards a little bit because of the fee that's typically associated with an income rider. We wanted to kind of get away from all of that. We wanted to not have distractions with complicated indexes, complicated product features. We wanted to kind of be clean and simple, very intuitive, very easy to understand, very, very transparent. So we're going to talk about some things today, kind of let you guys in behind the scenes, so the pricing a little bit, just to show how transparent we want to be. And what we wanted to be laser focused on was industry leading performance. You guys, Teton is not a jack of all trades. We are not trying to be something for everyone. We are trying to do one thing excellent, and that thing is accumulation. End of story. The other thing that we want to do is, just like we've been so consistent on the MYGA side, we want to be just that consistent on the indexed annuity side. I can't promise you what our caps are going to be every month. What I can promise you is we're going to be very, very consistently competitive month in and month out, and help you guys kind of get to know us on the index side, just like people have been getting to know us on the MYGA side too. So where we ended up was we have one product line, Teton, but with that really comes two different series. We have our Teton 7, 10, and 14-year products. You guys, these are our kick butt accumulation products, okay? These are going to have our best caps, our best participation rates, hands down. Teton Bonus, the sister series, also has a 7, 10, and 14-year. Here, we have a premium bonus included in each product, and the trade-off for that is slightly lower caps. But as you're going to see, the caps on Teton Bonus are still very, very competitive. It's not one has accumulation and one doesn't. All of Teton products have great accumulation. Commissions are the same between all the product lines, and all of the product features are exactly the same. The only difference is, do you want a bonus or not? And if you want a bonus, you're going to have slightly lower caps. That's it. So here's kind of how we get started. So the 7-year products can be written all the way up to age 90. The 10-year products can be written up to age 85, and the 14-year products can be written up to age 80. The minimum premium is $10,000. We do allow additionals for the first 12 months. The minimum is $2,000, and the maximum total premium is $1 million. Again, we are open for business. Send us those premiums that are larger than that. We have a large case approval form that that's on our portal that help us get those approved quickly. For those additional premiums, they're all allocated to the fixed account for the remaining of the first policy year. Full premium bonus applies to them, full commission applies to them, and then after that first policy year, that's when they get reallocated to the index crediting strategies, or however the client allocated their funds. All right, let's talk about the star of the show, and that is accumulation. Right now, we are solely focused on the S&P 500. We intentionally did that at this point, just because, again, the S&P is so transparent. It has such a long history. When people talk about the market is up, people are typically talking about the S&P 500. We have a great piece on our portal. I encourage you guys to check it out. The Annuity and Life Source can send it to you guys, called How Your Annuity Will Grow. It actually details how fantastic the S&P is, why it is the benchmark of the U.S. equity market, how companies can even qualify to be included in it, what they have to do to maintain their inclusion. It also talks about how I think it's like $9 trillion is benchmarked to the S&P. So it really talks about why the S&P is such a great index to tie things to. It also details how all 6 of our index crediting strategies work. This piece is client facing, so you can show your clients, how annual point to point works, et cetera, et cetera. We do have 6 strategies as well as the fixed account. We intentionally picked the 6 that we did because they work a little bit different from each other with respect to option pricing. Don't worry, I'm not going to get all technical, but depending on what goes on with volatility and interest rates, monthly average can price a little bit different than monthly cap or annual point to point. And so what we intentionally did was we wanted to pick strategies that we will always have strategies that will look good, essentially, that are competitive. Okay, no matter what happens with volatility, you will have great buckets to talk about for new clients. And what you'll also have is great buckets to talk about upon renewals as well. Again, the renewal component is very, very important to us. So we wanted to make sure that our clients, that you guys are all set up for success as far as renewals goes as well. All of our strategies are 1-year strategies. We're not looking at 2- and 3-year waits to get interest credited, and we don't have any fees on anything. So again, every year when you meet with your client, you're never going to have to talk about going backwards unless they take out a withdrawal or something like that. So here are our current rates. These are being held all the way through June. We'll be setting our July rates in the next couple weeks. This is the Teton. This is our biggest cap line. So I kind of like starting with the 7-year because everything just gets better after that. So here we have our short 7-year. Look at that, fixed rate of 3.25, annual cap of 6.25. Look at that, 50% participation rate on a short 7-year product. 2.25 monthly cap, and then we have 3 different monthly average strategies. We have monthly average cap of 775, or a participation rate of 80, or a spread of 125. Don't let your mind play tricks on you. I know a lot of people are used to seeing monthly averages with multiple adjustments, our participation rate and a spread. These are all unique strategies. Someone can pick one or the other, combination, whatever you want to do. But with all of our buckets, you will never have more than one adjustment apply to any crediting strategy that we have with Teton. So again, we're not playing any games with any of that. The 10-year, love it. We got our annual points of point cap up to 7, our participation rate up to 55, and I just love this monthly cap of 2.5. Monthly cap pricing has been really tight the last year or so. I mean, you guys see it out in the market. There's so many monthly caps out there that are below 2%. So we're thrilled to be at 2.5% here. And again, fantastic monthly average buckets. And then the 14-year, the 7.25 annual point-to-point cap, my personal favorite, this 60% participation rate. Great monthly cap again. And now we have a double-digit monthly average cap, and we are really close to an uncapped, or not uncapped, but we're close to 100% monthly average participation rate on this one as well. So fantastic caps on Teton. And then we move on to Teton bonus. The caps are a little bit lower, but you guys are still really good. The 7-year has a 5% premium bonus. The 10-year has a 7% bonus, and the 14-year has a 10% bonus. But, when I look at competition for Teton bonus, when I look at other bonus products, I see right now in the market, there seems to be a really big trade-off between, just kind of your plain accumulation product or your bonus products. A lot of the bonus products out there just have caps of 3%. A lot of them then have fees on them. With Teton bonus, you still have really good caps. I mean, look at the Teton bonus 10. We still have a 5.5% annual point-to-point cap. We still have a 2% monthly cap, good monthly average caps. And then the 14-year, you guys, we still have a 50% annual point-to-point participation rate on the 14-year product with a 10% bonus. And look at that. We have a 3% fixed rate. That first year, you can get the bonus, just go in the fixed account, be at 13% interest credit for the year, right? Fantastic. So again, we do not have a huge trade-off between Teton and Teton bonus. They're different products. Teton bonus certainly will help if someone's trying to make up some surrender charges or they had a loss in the market, but it will have good accumulation as well. So after we tend to go through our rates, I tend to get a lot of questions about, how are you guys doing this? These rates look really, really competitive to what we see out in the market. Are these bonus? Are these, initial offering kind of rates, et cetera? And no, that's not the case. Again, we are being extremely consistent with Teton. And what we did when we first started designing this product, again, we were laser focused. We knew we are designing an accumulation product. Okay, so what we did was we removed anything that could potentially drag that option budget down. For example, we haven't talked about income riders at all with Teton, right? Again, we're not being something for everyone. We don't have an income rider on it. Even if we put on it a terrible income rider that was completely uncompetitive and you guys didn't care about it, still having that income guarantee would have brought our option budget, our caps down a little bit. So we said, nope, not worth it, not doing it. We're also doing 5% free withdrawals instead of 10%. However, we have a little extra bonus built in there that we'll talk about in a minute. But that change from 5% to 10 or from 10 to 5%, guess what? We got to make our caps a little bit higher as well. So every step along that product development process, as we had to make a decision, we said, okay, is this going to help caps or hurt caps? If it helped it and it helped marketing, we're all in, we did it. If it could hurt caps, then we seriously considered if it was worth it or not. So again, this is just an accumulation product built from the ground up without having a lot of the drag that's on a lot of products. That really made us a lot more efficient in getting to those strong caps and adjustments. Another component I want to tell you guys about is this product is designed to have level option budget pricing. So I'm letting you guys in behind the scenes a little bit here. This is an important concept. No matter what product you're selling, you should find out if they're using level option budget pricing or not. I'm going to walk you through how it works. Let's go back up to Teton 10 real quick. So you can think of our fixed rate of 3.5% like our option budget. And what that means is if someone wants to allocate to indexing, we take the 3.5%, we go to Wall Street and we say, what will it get us? Today, it gets us a 7% cap. We are going to do that every single year. So next year, year 2, we're going to take 3.5%. We're going to say, what's it going to get us? It might get us 7.25. It might get us 6.75. But you know what? It's going to be really close to 7. I can't guarantee 7 because volatility can change, different things can change, but it's going to be very, very, very consistent. And guess what? We're going to do that every single year. Year 4, year 6, year 10, year 14. We are spending the same amount on options every single year. You guys are going to love this. It means when you guys meet with your clients for renewals, you're going to have strong renewals to talk about year in and year out. I don't know if I could come up with a scenario, for example, where a 3.5% option budget can buy me a 4% cap. Just too low. You're going to be close to 7% every year. Don't get me wrong, they'll move a little bit, but it's going to be very, very close. And I know that a lot of insurance companies have, year 3 or year 4, they have kind of a bogey built into pricing, and that's when they actually start dropping their option budget, and that's when you see those caps drop. Again, at Equitable, we do not have that in there. We are doing level option budget pricing throughout the duration of the policy. Another thing is we are focused on the S&P for transparency because of how well known it is, just like I mentioned, but also the S&P has the largest and most efficient option market in the world. So when we take our 3.5% for Teton 10 and we go to buy an option, we get the most bang for our buck on the S&P. Other indexes have bigger licensing fees and different things, and all of that is drag, and all of that brings down those caps and participation rates. That's another reason why we're focused on the S&P. And again, all of this leads to that consistency and how important it is to us to be a consistently competitive long-term partner for you guys. So moving on, we can talk about liquidity. So free withdrawals, RMDs are available right away, just like on secure savings. 5% of account values available starting in the second year, just like on secure savings. In addition to that, we have a cumulative withdrawal feature that is available all the way up to 30%. What that means is if someone doesn't take out their 5% free this year, they can carry it forward to next year. And next year they can take out 10. If they don't take out their 10, they can carry that forward and take out 15 the next year. They can keep going all the way until they max it out at 30%. We know that liquidity and flexibility is very, very important, but on the pricing side, we also know that few people actually use it. So we want to have it available, but we also want, if someone hasn't used it, we want to reward them so that in the future, if they have an unexpected need come up, they haven't been taking out their liquidity, we'll accumulate it for them and they can take it out later, at a point of need. We also allow annuitization. The 7 and 10-year products can be annuitized full account value after 5 years, and the 14-year product, the full account value can be annuitized after 10 years. And they can all be annuitized, for a 5-year period certain, or, lots of other income options are available as well. We also have a home health care rider, so people can get access to a big chunk of their account value if they cannot do 2 out of 6 activities of daily living. We have a nursing home that helps out if someone becomes confined. We have a terminal illness rider that if someone has a life expectancy of a year can help them out as well. All of these benefits include the premium bonus if Teton bonus was purchased as well. That premium bonus is automatically included in the calculation of all of these benefits. Wealth transfer, full account value available at death, spousal continuation available as well. Again, all of this includes the premium bonus for Teton bonus as well. All right, so here are our early withdrawal charges. So the 7-year and 10-year products start at 12%, the withdrawal charges, and the 14-year product starts at $14.75. Now keep in mind, these only come into play if someone does something that is greater than all that liquidity we talked about before. So free withdrawals, these don't apply. Death benefits, these don't apply. It's only if someone takes out, more than their free withdrawal amount, etc. Here, Teton bonus, same withdrawal charges. We just added the bonus recovery schedule. Again, the bonus recovery schedule only applies if someone does something where they get hit with a withdrawal charge. Does not apply for free withdrawals, nursing home, annuitization after 5 or 10 years, death benefits, anything like that. Now, you guys know there's some states, like the state of Washington, that doesn't allow us to go up to 12%. In those states, we have a different version of the product with withdrawal charges that start at 9.3%. Commissions are the same. Interest caps, participation rates are slightly lower, like instead of a 3.5 fixed rate, it is 3.25. So caps are slightly lower, not much different. The only other main change is in those states with the 9.3% withdrawal charge, the Teton bonus 10 has a 5% premium bonus instead of 7. So definitely call the Annuity and Life Source to make sure that you have the right version of the product in your state. That 9.3% version, it's in a number of states, but a few, that are off the top of my head: Texas, Missouri, South Carolina, Ohio, Pennsylvania, Washington, Oregon, those states. In those states as well, the 14-year products are not there, but we'll look at the state grids here in just a minute. All right, now we get to talk about illustrations. And look, I'm an actuary. I get really excited about illustrations, but I'm really excited about ours. We actually are unique in that we decided to build our illustration system completely in-house. And that means we got to make it look really great. And it also means we get to make enhancements really quickly to it as well. I'm really excited about our system. It's right there, built into our portal. I'll even walk through an example to show you guys how quick it is to generate an illustration. But let's look at a little bit of the output here real quick. So I know that we all want to run the best illustrations we possibly can, right? So from back in the day, when I would be looking at a different product, I would maybe have to run like 15 different quotes to see how the product looked with different strategies. We just tell you guys, okay? So on every illustration, you see this chart. I'm going to blow it up a little bit, but here we're showing you that the last 10 years, the annual point-to-point with a cap would have had an effective yield of 502. Participation rate would have had 702. The other bucket's around 5%. So we tell you right there. So before you go and run 15 different quotes, you can see, okay, do I want to put in 100% to participation rate? Do I want to do a combination? Right away, we give you the information so you guys see how the numbers are working in the engine. We do the same thing for the low scenario as well. Here, we're in the 3s, 3 to 4s. And we also do the same thing for the high scenario. I always want to pause here and remind everyone, these rates of return are account value rates of return. I know when we get up to 7 and 8%, 9%, et cetera, sometimes, again, our minds can play tricks on us and make us think that we're looking at an income-based income account value. Nope, again, these are straight up account value numbers. Also, remember, we're getting these kind of rates of return on the straight up S&P 500. We're not talking low volatility. We're not talking about other indexes. We're talking straight up S&P 500 and all 1-year crediting strategies. We're not having to go out 2 and 3 years to get these kind of rates of return. The other thing I always like to remember is the S&P 500's average yield, if you go back to 1950 or 1960, it's 8.5%-ish, okay? So we're able to provide almost all of the upside with the S&P 500 on, just a pretty clean indexed annuity with the worst case of 0 as opposed to, 50% losses like the market can get sometimes. So anyway, so these charts are in every quote that you run. And what we'll do real quick is, and don't be scared, again, this isn't going to take a long time. I'm going to show you guys how quick it is to run a quote. So when you go onto our brand new portal, you can get to the illustration a couple spots right on the home screen. Down at the bottom right, you can hit Run Illustration. We'll go ahead and make one real quick. I'll just stick with Teton 14 just since that's what we've been looking at so far. Put in the age. If you have a joint owner, you can put in there. Otherwise, you leave it blank. We'll just keep it clean and simple. Go with $100,000. If you have additional premiums, you put it in here. Otherwise, you keep going. And this is where you can choose how to allocate. We just saw that the points spent with participation rate looks awesome. So we'll go ahead and just keep it simple and allocate to that. And then this is where you can select if you want to show withdrawals. You guys, we don't have an income rider, but we do let you illustrate withdrawals. You can illustrate none. You can illustrate a certain percentage of the account value coming out each year. You can do 5%, 4%. You can also illustrate a level withdrawal amount coming out as well as RMDs. And we're going to look at some case studies. We may not have an income rider, but you better believe with this kind of indexing and the accumulation engine in this thing, we absolutely can provide fantastic income with Teton as well. This time around, I'm going to keep it simple and just do none there. So here's my favorite part of our system. We enter that information in. We don't even make you generate the whole big 15-page PDF. We give you information to see if you want to commit or not right away. So here we see this is how we allocated. And then we have some interactive charts down below. So we're showing the 3 different scenarios we have to show. Last 10 years, the worst 10 years, and the best 10 years out of the last 20. And you can see how the account value would have grown. So as you scroll over, it tells you, and at the end of 10 years, the $100,000 in the low scenario would have grown to about $147,000. For the last 10 years, it would have almost doubled to $197,000. And for the best 10 years, it would have more than doubled to $219,000. Again, we're talking account value here. We're not talking about benefit-based income account numbers. And then if you keep going down, you just see the numbers backing that up. So here you see for the last 10 years, the effective rate of return was 702. Well, the market did pretty well with 1075, but we still did awfully good considering we're in an indexed annuity. I love looking at this one. For the low 10 years, we would have had 393. Doesn't sound amazing until you see what the S&P did. Minus 6% every single year effectively for 10 years. You better believe 393 sounds amazing compared to 618. And then for the kick butt best 10 years, we're at 818 versus 13%. Here's those charts I was telling you about. So if you allocated one of the other ones, then right here you could see, oh, okay, well, this blue bar is larger. We should maybe switch our money there. And we show it for all of the different crediting strategies. And we have all of our numbers down below. So you can kind of go through that. Then if you want to make a change, you don't have to start all the way over. You can just click and you can say, okay, let me do 50/50, and then you keep going, okay? And then once you're done, you can print PDF and you're good to go. So that's our system. Gosh, that's, pretty quick to go through all of that. So let me switch back to the PowerPoint. So here's how the output looks. It looks very, very nice, very professional. We have color. Hopefully it's fairly intuitive to get through, so you'll get the full illustration once you're done. Now, let's go through a couple case studies. We'll stick with what we just looked at to start off with. 60-year-old, no money coming out. We're just going to sit back and let the annual point-to-point with the 60% participation rate do its thing. So here's how the numbers page kind of looks. One thing I always like to point out, we show that 702 rate up here on the top right, excuse me. One thing to remember, this is our actual credited rate, okay? Other companies, they might say 7%, but then what do they have coming off of it? Fees, other things, right? Well, not other things, fees, fees really. Our 702 is essentially our net rate. That is our engine. 702 is our engine in this particular illustration. So then we show the scenario, the last 10 years. And we start off hot with a 1407 interest credit, but at the end of the day, this is a very typical scenario. We have 3 years of zeros, we have a couple okay hits, and then we have a couple great hits, double-digit hits. I was really excited to see this scenario because I feel like it is reasonable, and that means that we are setting reasonable expectations with our clients as well. Sometimes you get a funky scenario where you show 9 hits and only 1 0, and that's when I have to kind of say, I just don't know how realistic that is. This is very, very realistic, this one. So we use that 10 years and we start growing the money. So that $100,000 grows to that 197, and then we keep going. And after 20 years, it almost quadruples to 388. We keep going. We have to show all the way out to age 110. So here we show your $100,000. If you indeed left it with us for this long and we had these interest credits, it could grow to almost $3 million. We also aggregate the total interest that we would have credited. So for this one, you gave us $100,000, we would have credited almost $2.9 million of interest. That's kind of a pretty straightforward one. Now let's add in RMDs. So same scenario, same indexing. But now at age 70 and a half, we take out our first RMD of $7,192. As expected, our account value dropped from 197 down to 189. Totally expected, right? Then things get interesting. We take out our next RMD of 7165, but we get our 14% credit. So what does that mean? We have now taken out 2 RMDs, and our account value is 208, which is higher than any other account value we've seen up until this point. This right here, you guys, this is the power of an accumulation engine, okay? When you have strong accumulation, you have strong income and you have strong death. Now, don't get me wrong, I know we don't have a guaranteed income rider, but we have strong projected income based on our indexed rates. And this isn't just a fluke, you guys. We keep going. We keep taking out income. At age 90, 20 years worth of RMDs, we would have received $284,000 of income. You're thinking, oh, surely our $100,000 is gone, right? We almost tripled it in income. Nope, look at that. We still have $224 left in our account value. Again, that's the power of the accumulation engine. What we have on every illustration is this column called the total benefit. It is the total income received plus the remaining account value. We add that up, and what this says is the total benefit to your client at age 90 would be $509,000, over 5 times their premium. Some of it they would receive in the form of income, and some they would receive as their death benefit or account value. But we actually add that up, so that's just another story you can pass on to your client as well. One thing I always like to point out too is look at this. All the way at age 110, our client would have received over $661,000 of income. And just now we're about out of money, but look at that. We're still not, we still have $15,000 left in the account value. So we don't have an income rider, but we have a fantastic built-in RMD solution. You don't have to pay a fee for this or anything like that, right? This is automatically built in. Run those illustrations, play with those numbers, and see if this can be a good fit for some of those cases you're working on. Now, if you're not talking about qualified money, this still works, you guys. So here we have the same situation, but at age 70, we're going to start taking out withdrawals of $9,000 every year. So everything's the same, but now I think we started at like $7,100 for an RMD at year 10. Now we're going to take out $9,000. Again, we see our account value drop based on that withdrawal, but then we see the big interest credit again. So our account value grows. Even though we're taking money out, our account value is growing. And at age 90, we've received $189,000 of income, and our account value is $352 for that total benefit of $541,565. And again, on this one, because our income's a little bit lower that we're taking out, look at that. We've received $369,000 of income. And oh my gosh, our account value is $991,000. So again, great, projected income solution as well. So certainly don't forget us if someone does need to take out some income. All right, so moving on, here is where the product is currently approved. The 7-year products are in 34 states right now. They will be in all 47 once we're said and done. Next week, we will be announcing Indiana and Mississippi, and Wyoming should be following quickly as well. So that will be exciting. And then same exact states for the 10-year products. And then the 14-year products are currently in 22 states. They will end up in about 33 total states, and Indiana, Mississippi, and Wyoming will be coming quickly here as well. Like I said at the start, we are constantly trying to think, how can we make it easier for you guys to do business with us and to set it up where we can give you guys the answers that you need quicker. So we're constantly improving things. One of the things we just came out with is a suitability pre-qualification form. This is on all of these documents are on our portal. This document will help us answer all of those questions about would you consider a case like this. So definitely check that out. We also have our suitability guidelines out there on the portal as well. The pre-qual form is just a one-page form. Fill it out, send it in. We'll get your answer back to you very, very quickly. Another thing we do that's kind of different is on our application, we actually let you purchase all 3 Teton products on one app with one set of signatures. So if you are doing some sort of laddering of annuities or something, again, you can purchase all 3 Teton or all 3 Teton bonus products on one application. Like I said, we have a large case approval form. We also have a great financial strength document that we put out there. Very, very transparent with all of our financials. And in fact, not only do we update this annually, we're also updating this on a quarterly basis so that you guys always have the most accurate information in front of you. Like I said, we have that How Your Annuity Will Grow piece out there as well as pre-approved client ads. Here's kind of a picture of one. You guys can just fill in your information on it and send that out to your clients as well. And we're also open to suggestions. So if there's anything else we can do to help you guys out, certainly let us know and we'll see what we can do. You'll find out that we respond typically pretty quickly to things. Last thing, we have a fantastic trip that we just announced this spring. We will be going next year to Nevis and the West Indies, where we will be staying at the Four Seasons. This looks beautiful. As we were picking between a couple of different trips and we saw and we looked at this one, and we were just blown away. So we're very, very excited. Hopefully it's a new destination that you guys haven't been to before. The qualification period already started April 1st, 2019 through March 31st of 2020. Our paid premium requirement is $3 million. We want to reward people who are consistently doing business with us. So we do have a minimum of 10 paid cases. But here's the thing, guys. If you have $3 million of paid premium with us over 10 cases, you're coming. We'll take everyone who qualifies based on those requirements, okay? Teton premium counts at 100%, Secure Savings Elite counts at 100%, and Secure Savings counts at 50%. Our trip dates are June 2nd through the 6th of 2020. So I guess now just actually a little bit less than a year from now is when we will be going. So with that, thank you so much for listening a little bit about Teton today. Here's all the contact information for the Annuity and Life Source, and I'll turn it back over to you, Heather.
Thank you, Carrie, for the wealth of information you shared with us today. We hope you are as excited about this new fixed index annuity offering as we are. To anyone that's posted a question during the presentation, we will be personally following up after the webinar. But if you do have further questions or would like any material on the products, please reach out to us at 800-743-7650. And on behalf of the Annuity and Life Source and Equitable Life and Casualty, thank you for joining us today.